Today we're going to talk about tax planning. This is a big topic that is becoming more important in our regular conversations, not only because taxes are going to be the biggest bill that you pay not only in your earnings career, but also in retirement. And from our perspective, if we can find ways to save on that tax bill each year, they can not only help you accumulate wealth faster, but also preserve that wealth longer term. In addition, tax rates are going to change again. They're projected to sunset the current tax rates here in 2026. This is a very important time frame to make sure that if there's any action that you can take, you want to be looking to do that and have visibility into that. And we're going to talk about that framework, some best practices here today, and ultimately drill that into a client scenario just to bring that full circle relative to some of the opportunities we have from a planning standpoint here. So Mike, why don't you kick it off and talk about really what tax planning is?
Yeah. So tax planning is proactively deploying strategies over the long term that are going to help you accumulate and preserve your wealth, but ultimately save you the most money on taxes. That's what it boils down to. We like to note that tax planning is not the CNBC article that you read on April 10th, describing how many thousands of dollars you'll save if you just do this one action this one time. It's usually simple little steps, but thought out over a period of time that, again, is going to evolve as your wealth and your situation evolves.
Yeah, we want to focus on really looking out the front window, because in our perspective, as you just wrapped up taxes here, that's looking in the rearview mirror. Either you're going to owe taxes, get a refund, or maybe break even, which is very difficult to do. But it's too late to make any changes. So what we want to do is look out the front window. What that allows us to do is plan for, say, the remaining part of this year and make any adjustments based on the 12/31 deadline on a lot of tax moves there. And the process behind that is really doing that year round. We'll highlight that here in just a moment. But the important part there is that you're not only planning for this for the remainder of this year, but you're looking even 5, 10, 15 years out. And if you can save anywhere between, say, 5 to 10% on your taxes each year, that can not only help you accumulate a lot of wealth, but also preserve a lot of wealth longer term. And as we think about really the removing that guesswork, it also creates visibility into how to maximize your tax brackets. This is super important, especially as we look at the ever-evolving tax landscape, because right now, 2026 is another year that we'll start to see tax brackets evolve again. And there's moves that you can make to potentially maximize each of these brackets to where they stand today, or removing the guesswork, understand if tax brackets revert back to where they were prior to 2018, then that allows you to really set expectations and have visibility into what that might mean for you personally and ultimate tax bill at the end of the day. But we're not the one-stop shop here, which is also very important to note. As we think about this planning, we will collaborate with your other financial partners, such as your CPA, accountant, to make sure that, as we start to look at these other opportunities, everyone that's part of the financial team is on the same page. Super important to make sure that we are collaborative in that approach and we got all team members on board, especially if we're going to make a significant change, like a Roth conversion or take a lot of money out of a retirement account that can create a tax bill at that point.
I think I understand what tax planning is, Neil, but now as a client, what are some of the things that I should be thinking about in specific strategies around tax planning?
First off, focusing on income planning. A lot of pieces of your wealth will be a little bit more predictable, but a lot of them will not. And that's why we think it's important to have this as an annual process to really understand, how you're trending, not only from a tax bracket standpoint, but any opportunities to make moves before the end of 12/31, the calendar year. So when we think about this slide here, looking at overall Social Security or your payroll income, a lot of those things are going to be pretty solid and fixed at that point. But as we think about the variable pieces of that, it's going to be even from investment income or capital gains income. And that's where later in the year you start to have better visibility in what that's going to look like that can help you start to optimize that income strategy each calendar year. On the other side of that, we have a lot of clients that are part of employee stock programs. This is something that is ever evolving just based on vesting schedules. Obviously, the nature of the vehicle that is vesting and what that means from a taxable income standpoint, but also tax withholding on that. The IRS sets a standard of what they need to withhold, which many times is significantly under what you need to pay. I'll use an example. Standard withholding is 22%, but if you're at the 37% tax bracket, that's going to be a surprise tax bill at the end of the day. So again, looking out the front window, having visibility into that can really allow for better expectation setting and no tax bombs or surprises, come April the following year. Okay. What else should we think about, Mike?
Well, once we have the full picture of income and we've had that conversation, we're really able to look at some different levers we're able to pull to ultimately try to reduce that taxable income. That's namely going to come in different contributions to accounts that you can make, whether that's into your retirement plans. You'll hear Neil and I say quite often, or all members of the STRAT Wealth team, make sure you're maximizing your retirement accounts, because oftentimes that's where you're actually being incentivized and receiving taxable income benefits to save there. Then there's also contributions to other accounts such as health savings accounts or HSAs or 529 plans or commonly used education savings account, where again, you're able to be incentivized to save or contribute money to those accounts that can ultimately reduce your taxable liability. So it's super important to use those first. Then we look into the realm of deductions and credits. A common one we look at is a common question we hear is, should I claim the standard deduction or should I itemize? Right. That's going to be a very, I'd say, tailored conversation, Neil, but it's really going to depend on if you own real estate, if you have high medical expenses, and ultimately what potentially your charitable goals are, right?
Absolutely.
Then last, we have credits. Then these are usually highly driven on your income tax bracket, but something that we'll show in the next few slides here as we look at the tax report and where each client is today. We look at what credits they potentially qualify for based on their income, and we do a full thorough review to really make sure that they're maximizing all those opportunities and taxable income reductions.
And the final piece we'll look at then is just the distribution strategy. And once you have all of the income itemized and accounted for, you have all your contributions, which is impacting your net taxable income at the end of the day. If you are in need of funds, you want to understand where do you take your next dollar, and then what's the potential tax impact of that. And obviously, working with a lot of retirees, they're questioning where their next dollar will come from, once their paychecks stop. And in this example here, just highlighting the discussion around, do you pull from dividends, capital gains, or retirement plans? Because each of these have a different tax treatment depending on what your taxable income is for that year.
We call this a tax report, or based on today's discussion, you can think about this sort of as the rear view mirror. This would be based on previous year's return and really shows a digestible picture of where you're at today from a tax profile. So as we look in the upper left-hand corner, it'll summarize income, the deductions that you're currently claiming, and then highlighted in red, we really like to dig into what's marginal rate that you're in currently, but then ultimately what's your average or effective tax rate as well. And we'll touch on why that's important in your distribution strategy here in a minute. And moving all the way over to the right, we look at capital gains and ultimately if there's any carried forward losses as well. As we start to marry the tax and investment planning conversation, we find there's a lot of crossover there.
Absolutely, and this is something, again, ongoing because all the previous activity from last year, there's important pieces that will carry over into the next calendar year. But knowing that some of these are variables, that will change each year, we definitely, just highlighting again to Mike's point, carry forward loss is a big one, because if there's something looming out there that you can use to your advantage based on either de-risking a portfolio, or if you think about selling real estate, investment real estate at a big gain, these are things that can help minimize your overall tax burden and just again provide better expectations going forward. What's not shown on here is this tax report will actually dig into the overall Medicare premium brackets, just based on your modified adjusted gross income. To highlight in the bottom right, taking a look at other opportunities to take advantage of, just based on how your income is trending. So we kind of have the green-red as that is again just bringing awareness to other opportunities that we want to have conversations around, just based on optimizing that calendar year at that point. So now that we look at the tax report, let's show how we really bring that in the fold of looking out the front window. And in this scenario here, we have 3 different scenarios. In this client case, they were really focusing on retirement and understanding where they can get their next dollar from. So as we look at scenario 1, that's really focused on what was in the past. Obviously, their income is going to be dropping off to 0, which is highlighted in scenario 2. And this is really just building out the base case of what we see in that client situation based on their other taxable income, whether it's inherited IRA distributions at that time, or even focusing on dividends and capital gains. So really building that out. And then scenario 3 starts to focus on in the future when they have to take the required minimum distributions. And this is the mandated amount that you have to take out of your pre-tax retirement accounts when you hit age 73 or age 75. So this is important because you can start to gain visibility of what the potential tax impact of that is going to be when that forced distribution happens, and then what opportunities from planning and optimizing kind of the tax brackets today you can focus on to not only fulfill your retirement income needs, but then 2, focus on any other planning opportunities such as charitable contributions, additional IRA withdrawals, or even Roth conversions at that point. Okay, so let's dig into some of those results of how do we utilize this in a client situation.
Awesome. So as we look at scenario 1 here behind us, again, that's showing the client's tax profile as of last year. And as we move to the right-hand side in scenario 2, now that the income is dropping off, we really want to look at 2 main things. That's first, what was the change in their marginal tax bracket? So you can see that's about a 12% shift downwards from 24% to 12%. Then we also want to look at the effective tax, and that would be for that future planning item of what would be the amount of tax they would pay on the next $1,000, either withdrawn from a retirement account or from capital gains. And I think it's pretty clear here, Neil, that if you look at the board in scenario 2, the most attractive tax rate is 0%. I know you would love to pay 0%. I think everybody in the room would love to pay 0%
100%.
on any dollars that they can take. And in this case, it happens to be capital gains in that year of retirement right here. When their income drops, they're able to pay 0% on up to a certain amount of capital gains. So with tax planning, we're able to look out the front window, again, alert the client of that opportunity, and even provide the appropriate range and amount of capital gains that they're potentially able to take at 0%. And that adds up to real savings in their pockets and hopefully an extra trip to Disney at the end of the year.
Absolutely, and we have the ability to look at solving for max, and that's solving to how to maximize the next capital gains bracket, even from 0 to next start of 15%. Next marginal tax bracket, just based on the next $1,000 of ordinary income, but also taking into consideration, as we talked about in previous conversations, the Medicare premiums. Because a lot of these activities can create a ripple effect that you might not find out for another, call it 18 to 24 months down the road. So again, you want to make sure you have visibility into all those impacts of potential taxes that you're going to pay. Okay. So obviously it's a lot of good stuff, and ultimately looking to optimize tax brackets and capital gains treatment. So what can clients expect forthcoming here in 2023?
Yeah, great question, Neil. So if you're a private wealth advisory client and you've made it this far through the tax conversation and you like what you see, what we're going to start doing is reaching out in May and asking for tax returns. Again, for all individuals who have filed in April, you should have those, so please provide them. You'll be able to securely upload them through our financial planning software. If you're one of the clients who's still waiting on a K-1 and you don't file till September, it's totally fine. The offer still stands. Just get it to them, get it to us once they're finalized, and really we're able to take it from there. If you provide us your tax return in a secure, uploaded way, we're able to start producing not only the tax report that you saw, but also starting to run the tax planning and actual scenario analysis as well.
Yeah, and this is going to be a big part of our conversation in Q4, just based on our private wealth year-end meetings, to really make sure we are looking out that front window, as we talked about here today, and focus on any activity or recommendations we can bring to the table before 12/31. So lots forthcoming on this topic, and certainly excited to really bring this to the forefront for all of our clients, and looking forward to working with you individually. Okay. So that concludes our topic here today. If you have any questions, please reach out to anyone on the private wealth team, or if you have topics you'd like to hear discussed in this type of format, let us know. We're happy to do some research and due diligence, and if it makes sense, we'll bring it to one of our next videos. So for now, have an awesome month, and we'll see you soon. Thanks so much.